Hi everyone, Thomas Moore here. Keeping a finger on the pulse of the market can mean different things. For me, it usually means making sure to check on the market each day, including my currently open positions. Sometimes it also means paying attention to market news. Now, I tend to take news with a grain of salt because while news, good or bad, can push a stock in one direction or another pretty quickly, these effects tend to be isolated to the very short term. In the long run, the direction a stock will move is tied more to elements like a company's financial strength and, in a broader sense, the ebb and flow of economic activity. With that said, sometimes I hear something that makes me sit up and take notice. A couple of days ago, I was interested to see a headline from Jim Cramer, the popular CNBC market analyst, saying that Apple Computer was the most vulnerable of the large cap stocks he and others have taken to calling the Magnificent Seven. That piqued my curiosity because for years I've heard Cramer refer to Apple as a stock you don't trade, you buy it, and then you hold on for the long term. It's a mantra that I've heard him repeat many times over the last several years, including the abbreviated COVID-driven bear market in 2020, as well as the more recent technical bear market that lasted for most of 2022. To hear him changing his tune now must mean something significant, right? Apple stock is in the midst of a bullish push that's seen the stock rally from a low at around $165 per share in late April of this year to its current price at around $223. That's a 35% return over the last 5 months, and it's a performance that would seem to confirm Cramer's first argument about the stock more than the idea that it might be in trouble. So what's the truth? Let's run the numbers and see if he might be right. Before we dive in, I'd like to invite you to help me grow my channel by liking this video and clicking the subscribe button. I also have a Discord server you can join for free to get early access to all of my videos. Paid members get even more perks, including my weekly Rebel Income trade alerts and access to my Friday YouTube live stream. You'll find the link to join my Discord server and to sign up as a paid member in the description area of this video. Apple's free cash flow increased from $99.5 billion a year ago to a little more than $111.7 in the last quarter. That's a healthy increase of about 12%. And signals healthy, growing profitability, which has been a primary characteristic of this company for some time. While Apple also boasts healthy liquidity at $61.8 billion in the last quarter, cash has declined from $73.1 billion 9 months ago and is stagnant over the last 12 months. Comparing liquid assets against long-term debt is a good way to measure a company's financial flexibility. For Apple, long-term debt has decreased over the last year by nearly $9 billion and is currently sitting at around $86.2 billion. One of the things that might make this analysis seem a little strange is the sheer size of the numbers we've just reviewed. It also might not help to remember that Apple Computer is one of the largest capitalized companies in the world, with a current market cap of more than $3.3 trillion. The key, when doing this analysis on any company, no matter the size, is to consider their historical patterns, and in the case of cash and debt, to compare them against each other. Increasing free cash flow, along with cash nearly equal to long-term debt, are both very positive indications. Apple's profitability has historically been very healthy, and that's certainly still true, as seen in part by the healthy increase in free cash flow, but also confirmed by comparing their net income to revenues. Over the last year, net income was 26.44% and declined slightly to 25% in the last quarter. An increase in the most recent quarter compared to the last year is preferable, but the fact is that these numbers confirm the healthy profitability demonstrated by rising free cash flow. While most tech stocks don't pay a dividend, it's become relatively common to see the largest tech stocks like Apple, Microsoft, and others paying a consistent dividend. For Apple, a $1 per year dividend is very modest, translating to an annual yield of less than 0.5%. While Apple could easily increase their annual dividend, doubling their dividend from $1 to $2 per share, for example, would reduce their cash by about 24.5%, but still leave more than $46.5 billion in available cash. The most important point is that they do pay a dividend. That puts them in a select class of stocks that make returning value to shareholders a point of management focus. Despite Apple's solid fundamental profile, the fact is that the stock is overvalued at its current price by a little more than 28%, with a useful discount price at around $128 per share. That's a relative level the stock hasn't seen since the beginning of 2023, when the stock's current upward trend began. The truth is that when you drill down to Apple's latest price action, the story is one of increasing volatility over the past few months. From a peak at around $236 in July, the stock fell quickly to a low at around $200 to start August, before rallying to its latest pivot high point at $230 per share before the start of September. The stock is a little below that point now and appears to be stabilizing. In at least one respect, Jim Cramer is correct about Apple being vulnerable. That's reflected by the 20 and 200 day moving averages, which are separated by approximately $29 right now. The stock is also below the green 20-day moving average line, suggesting that immediate resistance could be very close at around $224, while current support is close by at around $217. A drop below that point could see the stock fall near to the 200-day moving average. That means that short-term potential downside in the stock could be as much as 13% below its current price, while upside to the stock's yearly high is only about 6% away. That puts the stock's reward to risk ratio at a little over 1 to 2, which is the opposite of the minimum any short-term trader would be willing to work with. I hope you found this information useful. Go ahead and click here to subscribe to my channel and get notified every time I upload new content. You can also click here to learn more about the principles that make my Rebel income system effective. I'm Thomas. Talk to you again soon.